Take a look at this ledger. You have a mortgage with a balance of $400,000, locked in at a 6.5% interest rate, and a required monthly payment of $2,500. Fast forward 5 years. You suddenly find yourself holding an $80,000 lump sum of cash. Maybe you sold another property, an inheritance landed, or a massive bonus finally cleared at work. That $2,500 monthly bill feels heavy, so you make the responsible choice. You write an $80,000 check, mark it Apply to Principal, and send it to your mortgage lender to lower your burden. The deposit clears, and your total loan balance drops by exactly 80 grand. But then the next month's statement arrives, and your required payment is still exactly $2,500. You handed the bank $80,000, and your day-to-day monthly bill didn't drop by a single cent. This timeline illustrates why. When you make a massive extra principal payment, it doesn't adjust the math on your current bills. It only knocks years off the far back end of the loan, decades into the future. By following standard financial advice, your $80,000 is now locked completely out of reach inside the walls of your house, and your monthly budget remains entirely unchanged. If you ask a standard loan officer how to solve this monthly cash flow problem, they will point you toward the most common tool they have, a refinance. But a refinance requires originating a completely new loan. You have to go through underwriting, get a new appraisal, and pay closing costs that typically drain between $6,000 and $10,000 right out of your pocket. This comparison shows the real damage. Refinancing wipes out your current interest rate, forces you into today's market conditions, and slaps a hefty 5-figure fee onto the bottom line. This leaves you trapped between two bad options. You can park your cash in the house for zero immediate relief, or you can pay thousands of dollars in fees to throw away an interest rate you fought to protect. But there is a third option sitting quietly at your mortgage company right now. It's called a mortgage recast, and executing it costs a flat administrative fee of about $250. A recast is purely paperwork. Nobody checks your credit, nobody asks for your tax returns, and no one orders an appraisal. Above all, your original interest remains untouched. Looking at this formula, here is how the math plays out. After you make that $80,000 deposit, your mortgage servicer takes the newly reduced principal balance of $294,000 and recalculates it, stretching it evenly across the exact 25 years you have left on the loan. The financial impact is immediate. Your required monthly payment plummets from $2,500 down to $1,988. You kept your exact original rate, you kept your loan, and you finally forced that $80,000 lump sum to actually reduce your day-to-day monthly expenses. For the price of a single dinner out, a recast converts a static pile of cash into permanent, immediate monthly relief. This mechanism comes with a strict set of rules. You cannot just call up a bank and demand a recast on any type of loan. First, this is almost exclusively a feature of conventional mortgages backed by Fannie Mae or Freddie Mac. If you hold an FHA or VA loan, you are generally disqualified from using this paperwork. Second, your servicer will not run this math for pocket change. They require a minimum lump sum contribution of roughly $5,000 to $10,000 to trigger the recalculation. And looking at this checklist, there is a third vital rule. You should never manufacture a lump sum by draining your emergency cash reserves or ignoring a credit card with a 20% interest rate. A recast is a precise tool for deploying capital you already have. It is not designed to fix a budget that is already stretched past its breaking point. Once you complete the recast, a new mathematical problem emerges. If you only pay the new $1,988 minimum, your smaller balance is stretched over a very long timeline, meaning you will end up paying more total interest over the life of the loan. To beat the math, you execute the recast to secure the lower legal requirement, but you voluntarily keep sending your original $2,500 to the bank every single month. Your $2,500 payment splits into two streams. The extra $540 goes directly towards principal, maintaining your exact payoff speed. But here is the strategic shift. If you face a sudden job loss, you drop down to the $1,988 minimum instantly. No permission, no penalties. Before the recast, the bank demanded the full $2,500 every single month, regardless of just how far ahead you were on your payments or just how difficult your year was going. The value of a recast is the ability to transform trapped home equity into an on-demand financial escape hatch, giving you total control over your money when you need it most.